So if like somebody wanted a Breaking Bad in their apartment and something happened, then the insurance company could go after them.
Subrogation is essentially an insurer's right to go after a responsible party. And then, so a waiver of subrogation means that the insurance company is essentially saying, we are going to insure this whole building, but and we're going to relinquish the right to go after an individual owner if, like, we're in a condo of 150, one owner starts a fire, it damages 30 units. The waiver of subrogation will basically say, we're not going to go after that owner. The blanket insurance policy is going to
Essentially,
cover it all.
yes. That specific scenario you mentioned might be up for debate because of gross negligence.
Yeah.
So it
And
doesn't
I was
cover
going to say,
illegal activities or gross negligence. So if like somebody wanted a Breaking Bad in their apartment and something happened, then the insurance company could go after them.
could still go after him. Yeah. And
Yeah.
another thing, I'm going to assume that not all of these policies are the same. Like, so I'm going to guess that how deep into the weeds do you have to get as a lender in looking at these policies and understanding, okay, because, if there's a waiver of subrogation on a condo unit and, they're all a little bit different, like what would stop you from being able to lend on a specific condo?
Well, if there was not a waiver of subrogation and the parties that basically decide whether they can make a change to that policy, for instance, like an HOA president, if they said, no, we're not going to, request a change to the master policy, then we wouldn't be able to get a loan on that because it's a Fannie Mae Freddie Mac thing.
Gotcha. So essentially that would make it non-warrantable.
Yeah, I don't really know if they don't. That's not necessarily like something that makes it warrantable or not warrantable. It doesn't really fall into that category. At least that's not how my underwriters, explained it to me when we ran into it. It's mainly just
sense.
a part of the master policy that has to be there.
Gotcha. So have you run into this before personally?
Yeah. So we had a deal in Dallas. This one didn't have the 150 units. It actually had 5 units. Or it was an odd number. It was either 5 or 7, something like that. But it was a small regime in a nice neighborhood in Dallas. And the problem I ran into there is, these units don't turn over that often. So that policy they've had has been there for years. I'd be lying if I told you I remember when the last time one was sold, but it was a long time ago, like to the tune of like 10 plus years. So it's not really something that was on their radar ever. So when I got and this was early on when I guess this was a kind of a new guideline. So when we got the condition to add this, I was kind of, I didn't know what it was at the time. So, going down kind of a wormhole of researching and kind of figuring out what I need to do. I called the HOA president and just explained it to him best I could. And of course he basically just pushed back and said, well, no, I'm not going to make any changes to this master policy. We've had this for years. You guys are going to have to figure this out. So I was like, okay, great. So my next step was I was going to go see if there was a way to just, waive that condition because it was new to us. Because sometimes when you can't get something, we can sometimes find our way around it. But unfortunately, this was a hard stop because it was a legit guideline. So I actually
Do you remember what specifically was the problem?
It was because the master policy itself did not have a waiver of subrogation.
Okay, so it didn't have it at all.
It wasn't in there at all. No. So because this is kind of new, not every policy has this on there.
Yeah.
So I called the insurance company and just kind of said, hey, can you call the HOA president and explain to him that one, this is something you guys are aware of, and she was the person I talked to. Believe it or not, was actually really helpful, which I was kind of surprised by. So she called the owner, kind of explained to them, what it was. And then I spoke with him again. And then he was kind of like, well, I need to make sure all the other unit owners are okay with this. And, after, a little bit of pushback, back and forth, we finally were able to get them to add that rider to the policy. And so, yeah,
Interesting.
worked
Does
out.
it, so I'm assuming that insurance policy goes up as a result of this, right? Because the waiver of subrogation would essentially be saying that that insurance company is relinquishing their rights to go after a specific unit for, to get paid back if there was a claim made on the unit as a whole. So I'm going to assume that increases the overall price of the insurance policy for all units.
Well, um, they did not bring up what the price of the policy was when they made the change, or they didn't bring up if that was going to change the price of the policy. So I'm not sure what effect that had on it. I'm going to
Gotcha.
guess that maybe because this was a policy they've had for a long time, it may not have had a big, effect on the price. Now, if you're, originating one from start, that probably will. So,
Yeah.
I wouldn't be. They didn't tell me anything as far as how that affects the price, I guess.
Yeah,
But
and
I
I was
would
going
think
to
it
say
would
that
make it more expensive. But I
though it'll
I think
probably increase HOA dues in the future.
yeah, no question. Um,
Yeah.
and I think the main reason why this is a rule now, I have to only assume that it probably happened, where an insurance company came in and sued a unit owner over a claim that they had to pay for, and then in turn that may have caused the unit owner to maybe foreclose on their mortgage. And so,
Mm,
things like that kind of spiral, for every
yep.
guideline, there was a lawsuit, that kind of thing.
Yeah. What is do you know anything about, so like it, we're seeing a lot in Austin of the, condo regimes, but they're all freestanding condos. So and when I've sold these before in the past, my owners have to get basically insurance policies as if they are a SFR, right? So
Right,
I'm assuming that there's exceptions for condo regimes if they are freestanding condos, like
right. Yeah, detached condos don't require a condo review anyways. Same thing with the
okay.
condo regime that's 4 units or less. So if you
Yeah,
have, like a quadplex that is converted to to a condo regime, then that would not be required because you don't have to get um, a condo review anyways.
gotcha.
This regime was 5 units, and I remember thinking to myself, if there was only just one less unit, would be doing just if I want.
It would not be
Yeah.
a problem.
Yeah.
Yeah. Yeah, interestingly enough, this hasn't come up for me in recent years, but I can imagine that it's something that on an older condo regime that maybe the didn't have high turnover, that makes sense that it would come up.
That's exactly right. So,
Yeah.
the stuff here in Austin, because, they turn more, I'm sure that this has been done already probably for the last couple of years, but, um, you know,
I'm sure there's still a few, dude. There always is.
oh yeah, I'm sure. But that's the only time I've
Yeah, what is do they require anything like this on those condo regimes that are just the AB units as you get closer to downtown, front back units, or is that complete because they're separate? I mean, some of these units actually now aren't detached. There's I've seen a bunch of them they still share a wall now,
right,
but have two separate addresses. So basically 2 units built on one lot. They have a square footage restriction on the smaller unit. It has to be, I think, like max 1,100 square feet, and then the bigger one can be a certain size. But I do believe they can share a wall. Do those require a waiver of subrogation? Do you know?
no, because those would be a 2 unit.
Oh, two
Um,
unit. Yeah, that
yeah,
makes
so it'd be
sense.
less than 4 units. Yeah, so like I've done a lot of deals, on those tear downs where they'll put 2 condo units in there, usually one big, one small. Um, But those are treated like single family homes because they're not attached. But on the ones you're talking about that are attached, they are treated as kind of a single family home just for the fact that it's 4 units or less.
That makes sense. All right, so now let's transition to what else is going on in real estate for you, Kyle. What's been
Well,
the deal of the week?
I mean the refi calls, the refi calls are coming a little bit. Yeah. So like, there was kind of a little window there where rates got, were, flirting with the eights some.
Mm-hmm.
So those guys are, you can get them in at, 5.99,
Yeah.
6% right now. I'm getting a lot of calls on the big jumbos that I did over the last couple years, but you know, because jumbos were priced a little bit better, 6.5, 6.75, those are not, quite ready. So I just been,
Yeah.
I'll just send somebody a fee sheet and say, here's your monthly payment. Because it's a guild to guild refi, there's no, um,
Closing costs.
closing costs except for your, like 60% of the title fees you would paid,
Yeah.
because it's within, a
Do
shorter
they
period of
have
time.
to, is it a full, when you refinance, is it a full owner's title policy that has to run again?
No, because of the length of time from the last title policy. So it's like,
Okay.
I think it's like
It's a reduced.
60%. Yeah.
Okay.
Yes.
Oh,
It's
so that's
definitely,
the 60%. It's not just the charge, it's the okay. I
yeah.
was assuming that 60% meant the lender covered X amount of it, but it's actually that's just what the
No,
title
it's just
company
because,
charges.
yeah, it's because how fresh the last policy was paid
That
for
makes
anyways.
sense.
Yeah.
The well, that's good to hear, man. If refis are starting to make calls, that means that rates are coming down enough to maybe spark some. I mean, I'm still expecting that we're not going to see a bunch of activity at this point until, end of January, February next year.
Yeah, and I think a lot of people kind of pumping the brakes too, just because of what they see on the news.
Yeah.
Like for instance, when the Fed is dropping the rate, a lot of people, and there's no reason for them not to think this, is if they hear Fed drops the rate the quarter, that they may think that means the mortgage rate is going to drop a quarter. But that's not what that means. So sometimes, if lenders already think that the Fed is going to drop the rates, then they'll actually, preload their balance sheets and kind of, set rates, ahead of schedule. So when you see that, sometimes, actually more times than not, once you get the news that the Fed is dropping the rate, then mortgage rates will take a tiny little tick up.
Yeah.
Uh,
That's what we saw,
come
and
from
that's what we've seen the last two times it's happened.
yeah.
The week after, we've seen a little tick up and then a slow kind of
Yeah. It's mostly
fade back down.
insignificant, but
Yeah.
well, I will get that little email, we are experiencing a reprice for the worst.
Yeah. And then, there's some certainty around the next one too. A lot of people are already saying it's pretty much a for sure thing that we're going to see another quarter point at the end of the year. What's your
Yeah.
thoughts on that?
Yeah. I mean, I get the little market updates every day. And that's exactly what they're saying. I mean, right now there's not a whole lot of economic news coming out because of the government shutdown. So
Yeah.
there's, there's less chatter lately. Um, and hence why I haven't seen rate movement at all either. So, um,
Yeah. So
but
in a
yeah.
perfect world, what do you see like if rates get into the mid fives by spring next year, what do you what do you predict like happening in the refi and resale business?
Well, no, I mean, the refi business is going to definitely boom because people are in the mid sevens. If you can drop your rate 2 points, I mean, that's kind of a no brainer depending on how much you owe.
Yeah.
2 points is pretty much always a no brainer. If you dropping your rate 1 point, usually like a 300,000, well, 300, yeah, $300,000 loan or more, a 1 point reduction, gives you a pretty good, drop in your payment. Unless you want to change the term or something like that, which I, run into that a lot. Then as far as resale business, I think, getting into the mid fives would kind of balance the market a little bit. I feel like we had the most balanced market ever when they were in the fours.
Yeah.
The homes that had the wow factor were multi-offer, but like two or three, and they weren't $100,000 over asking. And then at the same time, homes weren't sitting for, 6 months where, a buyer can come in and say, hey, this home's been sitting for 6 months. This guy's owned it for 5 years. I'm going to offer them $100,000 less because they probably need to get rid of it. And
Yeah.
so, I think kind of meeting in the middle there with, the fives, I think that'll balance things out for sure.
Yeah, that back into like what 2017 through 2019, we've pretty much fluctuated like fours, low fives,
Yeah. And then the
relatively
Govy loans will get
consistently.
into the threes. The FHA
Yep.
loans they were typically going to be lower. So yeah.
Yeah, it'd be nice to be slowly drip back into that so we can see some steadiness and like from the real estate perspective on our side, we see the buyer pool is very different than what it normally was. We're not seeing a lot of in-town moves. We're not seeing a lot of people
Yeah.
sacrificing their current interest rate to move up into a better house. We're seeing mostly people move-ins to the city, move outs of the city, and then, your standard, somebody passes away, divorce,
Yeah.
major like job loss, those type of things. Those are what's, I think, what ultimately is driving our market at the moment, and so it'd be nice to actually see some of those in-town moves again, people being able to afford to, I've had a good couple years, like we'd love to sell our house, move into a bigger house, that type of situation.
Yeah, no question. I think that's one of the biggest deterrents right now is people sitting on a 2.5, 30-year fix that, hey, I want to upgrade my home because I need more space because we had a couple more kids, and they go look at a home that's bigger, and let's say it's $200,000 more than what they paid, for their house, but $200,000 more home, and let's say that person's still, in the same kind of down payment situation, like they're, going to put 10% down because they probably want to keep their current home, anyways. But when you look at, because of the low rate, um, but you look at the increase in your payment on a house is $200,000 more than the one you bought at 2.5, and then you're at 6.5. I mean, it's astronomical.
Yeah,
So,
it's that
and then
sticker
why would they
shock.
sell that house? I mean, that's almost free money.
Yeah,
Two and a half
exactly.
percent. I mean, I wouldn't
Yeah,
sell that.
it's the situation my family finds themselves in, like we'd
Yeah.
love to have a little bit more space, a little bit bigger house, especially after, renovating this house. We kind of know
Yeah.
what we want in the future, but our interest rate and our monthly payment is holding us here because even if we took all the equity from our current house and put it into the next house and bought what we wanted, we'd be doubling our payment monthly,
Yeah. Easily. I'm in the
to
same
easily.
situation.
Yeah, so it's just not realistic at the moment. So it's really easy to understand and empathize with people that are, doing these calculations and like, yeah, not for me right now.
Yeah.
But it'd be nice to see rates get down enough to relieve some of that burden. So people that, have the income, have the ability to make those moves are in a position where like, oh, okay, it's worth it for us at this point. The increased cost is still worth it for us to pull the trigger and make this move.
Have you been hearing from first time home buyers?
Man, this year has been non-existent. The difference
Yeah.
between this year and last year, we actually had a relatively decent year last year, towards the tail end of the year because we had a bunch of first time home buyers that we got into new construction.
Yeah.
We've had one this year. So compared to, I think we had seven last year. So
Yeah.
and first time home buyers in new construction and first time home buyers and, sub $350,000 properties, we're just not seeing any of it right now.
Yeah.
So there's a lot of hesitancy in the market still, and understandable, but I'm hoping, interest rates can be a driver to impact that. Property taxes and insurance as well. But, my hope is that insurance and property taxes don't go up enough to offset an interest rate drop next year, which would and essentially put Austin
Yeah.
in the same conundrum as before.
Yeah.
So fingers crossed on that one. So
Yeah. Well, I haven't noticed insurance going down yet. I was told that, you know, we might see things lighten up. I haven't seen that yet. So I've been building $250 a month in for insurance, and more times than not,
which
that's been
is
kind of spot on, which is insane. Because
yeah,
I
dude.
remember when I used to do $100 a month. Feels like not even that long ago.
Yeah, dude. And yeah, I remember in 2018, 2019, our standard when we'd put into a fee sheet was going to be like $100 a month.
Yeah,
And oftentimes that was high.
yeah,
People's, homeowners insurance was like $75 to $90 a month,
yeah. Because they're
so
bundling with their cars and stuff, and
especially on new construction, and even new construction, homeowners insurance now is up over 170 a month,
yeah,
which is bananas. I'm like, that house shouldn't, outside of a catastrophe, shouldn't require an insurance claim for 5 to 10 years,
yeah.
so, but yeah.
Mine went down $50. Now I pay 28 something, but it was like 29. So I think I'm like 28.50 from 2,900. So that's pretty exciting.
Yeah, our house has everything new on it. So ours is actually we fully renovated. So ours is
Yeah, that certainly
cheap-ish,
helps.
the
Yeah.
key
I mean,
word
I'll even
there.
take 2,800 because I see quotes sometimes that, get upwards into the mid threes, 3,500, 3,600, and
Yeah,
make
dude,
it feel
in
good.
specific neighborhoods too, like out towards, like you get out towards Steiner Ranch and some of those areas in the hill country, because of the potential fire hazard,
Yeah.
and how those neighborhoods are built out. Some of those insurance policies are astronomically high. Yeah, I've had clients that have paid anywhere from like 10 to 15,000 a year in insurance premiums on a $1 million plus property because you know it's in an area where if there's a fire, there's a good chance their house is going up in flames. So they, the insurance adjusts just like everything. So,
Or they don't offer insurance at all. I just saw a post on my on our neighborhood Facebook page here in Leander. I don't remember. I want to say it was a big company like Allstate that would not insure them because of their fire risk.
yeah. Well, that's what happened in California. Like I think
Palisades.
it was like, yeah, it was like 6 months before, all those insurance renewals were denied.
Oh
Like
yeah,
I think State Farm,
people
all of
got
them
left holding
basically said
bags. Yeah,
they were like, we will not insure for fire hazards anymore because, and some of that was political too, because like I guess the city the insurance companies had basically said, we need you guys to do these things to help prevent fire hazards or mitigate risk. And then I think the city denied that, which I can understand both sides of that, because who wants an insurance company dictating what you can do in your city?
yeah.
But at the same time, it's a pretty dick move by insurance companies to
Yeah. I
pull
know they're
their,
supposed to like sweep the forest. Was that what it is?
yeah, something like
I think
that,
they
which
literally
is,
wanted them to like rake thousands of acres of forest. That
yeah. And you're like, that's,
who's doing that job?
correct. And then on top of that, like those, what do you, that, all of that debris ends up ultimately turning into dirt at some point. The
Yeah,
problem is just
just need
when it
some
gets,
rain.
yeah, just, and Californians not getting it. So,
Yeah.
I mean, a lot of places we're not getting it right now either.
Well, we
So,
finally did. I think
oh,
this was the biggest drought, like fall drought in like 50 years, something like that.
yeah, it's interesting because when I first moved to Austin, I moved here in 2012 and we had 2 years, like right around this time of year, Halloween ish. Remember the Halloween floods? I think it was 2014.
Was that
Um,
during Halloween?
It was Halloween.
Yeah.
Downtown
Okay.
and Onion Creek flooded. And then we had this string of like 3 or 4 years where we had like flooding every year because of these torrential downpours. And then we've
Yeah.
had nothing. I mean, we had the flood earlier this year in Hill Country,
Yeah.
but even that
Sandy
was,
Creek.
yeah, that was just the
That's
dump.
right around the corner from me,
Yeah.
like a couple
It was,
miles.
dude, yeah, Georgetown was bananas. Like it
Yeah.
was almost as bad as Johnson City or not Johnson City. Was it Johnson City?
Jonestown, right?
Jonestown. That's what it was. Yeah.
Yeah.
Whatever the one. Yeah.
Are you talking about
Where
like
where
there's a
where the
park in
camp was.
Jonestown. Yeah, yeah, that's Jonestown, where you
Okay.
could literally
Yeah.
walk across the lake because it had dried out. And
Yeah.
2014 it filled up, and then now I haven't been over there, but I know they got water again.
Yeah. Interesting.